everybody, and welcome to my latest in the crypto webinar series that I've been holding. My name is Michael Bridey, and I'm an FX and crypto specialist here at Bloomberg. Today, I'm proud to be joined by my friend and colleague in the market. I've met at plenty of these events before, Michael Rapkin, who is the head of institutional sales and global partnerships at DV Chain, as we discuss cryptos, the good, the bad, and the risks. Before we get started, I just want to remind everyone there is a questions tab at the top on your screen there. Please click on that if you have any questions for us or any topics that you would like us to discuss in the future. Just put them in that little question box right there. But before we get started, Michael, thank you for joining me today.
Thank you for having me, Michael. It's our pleasure to join you and excited to do this with you.
Excellent, excellent. Before we get started, tell me a little bit about yourself. Tell everybody about yourself, DV Chain, and any kind of projects that you guys are working on right now.
Yeah, for sure. So I'm the head of institutional sales and global partnerships at DV Chain. We're one of the world's leading crypto trading firms, providing liquidity and market making services to institutions and exchanges around the world. We support over 80 assets and 400 tradable pairs, giving our users the option to trade via multiple interfaces, multiple APIs. Many institutions around the globe really depend on our robust, stable tech stack to help power and help scale their businesses. So, pretty much high level, we know the mechanics and plumbing of both the traditional securities market and the opaque, less understood crypto markets to help create solutions that help our clients experience less slippage, ultimately leading to a better ROI for them.
Oh, that's great. So let's get right into it. You mentioned a little bit about the current markets right now, the current state of what's going on. Let's talk about the overall landscape. A lot has gone on in the past 3 to 4 months. What was broke? There's a lot of news out there about lenders, leverage, collateral risk. What's your take? I mean, it's always nice when things break down because we build them up better and that's how things get better. But what's your take on kind of what happened in the past 3 months and how this is going to may point us in the right direction?
Yeah, for sure. And, as you have your ear to the ground and as do I, you've been hearing from a lot of people, right now is the time to build. And so let's before we get into that, let's rewind a few months, maybe back to February, when the war started. And so, we were already kind of getting into choppy markets, whether it was traditional or crypto at that time. And then the war started and really kind of the risk on sentiment moved to risk off. And that wasn't just for crypto, that was for traditional. And, when you look at what happened on that sense, that kind of was the first trigger, and then if you kind of dive deeper into crypto markets, you started seeing prices being choppy a little bit, people getting worried about where we're going to be in the next few months, where we're going to be in a year, and not just on a crypto sentiment, but on an overall market sentiment. And then, in May, prices started moving down pretty aggressively. And there were certain borrowers out there, certain hedge funds out there that were kind of in the market and highly leveraged in the market that when those prices started moving down as aggressively as they did, they couldn't meet their loan requirements, right? And they couldn't meet their margin calls when a lot of the lenders were knocking on the door. And so that's kind of the first aspect of it. When you're starting to move down the chain a little bit and you're looking at a bunch of lenders who were out there with, unsecuritized, less so unsecuritized and more so under collateralized. And so if you have an under collateralized loan in the market that's moving down pretty aggressively and a bunch of lenders are knocking on your borrower's door for margin calls, there's a higher chance or a higher risk of default happening. And really that's what we saw, right? We saw a bunch of over leveraged companies that took money under collateralized from a bunch of lenders. And then we saw the trickle effect where, those companies couldn't meet their requirements and then the lenders couldn't meet their requirements. And in a sense, it kind of weighed on, some of the retail and institutional clients out there who kind of ended up holding the ball and not being able to play with it. Right. And so that's really what we've seen, from a negative standpoint over the last few months. But I think that's just like any other industry, it's a learning experience, right? So we unfortunately forgot that 2008 was only 14 years ago. And we forgot that how leveraged markets were then. And unfortunately, we just made that mistake in crypto as an industry. And I think it's only going to be upward and onward from here because, now we've kind of scaled back as an industry, looked at what can we do better? How do we manage risk better? How do we mitigate risk better? And, we're moving forward in a much better and positive sentiment.
Well, that's great. You mentioned collateral several times there. since February, since you mentioned, and it's really good that you did mention, what happened in the markets globally, right? Because what happened in cryptos here was not a one-off event in this specific industry or asset class, right? This is kind of a global thing that's happening across the entire financial ecosystem right now with inflation and everything that's going on, like you mentioned with the war and stuff like that. But how has collateral changed, or has it? Have we learned? Like, are people accept? Has that model or best practices changed a little bit?
Yeah, it definitely has, right? Many companies, including ourselves, could have gone out into market previously, and with our reputation, we're able to most likely get an under collateralized loan, right? And that's definitely changed over the last, I want to say, 6 weeks, pretty aggressively, where borrowers have now switched their position, and lenders are asking borrowers to over collateralize, which essentially makes them the lender, right?
Right.
And we as a prop firm, as a liquidity provider, we definitely understand why they're doing that, and it makes sense given what's just happened in the market. And for some lenders out there, it's a much better practice to be able to ask companies to over collateralize. And in that sense, there are assets that companies sit on that they're not essentially, they might not be using in the moment to trade with, and they might be willing to over collateralize and get something out of the lender that they're able to actually utilize on the market.
Sure, that makes sense. And when we look back at the last, I don't know, 3 or 4 months again here, it looks like volatility, right? It's kind of come off a little bit. We're kind of stuck in these little ranges down here and all these digital assets. Is this decrease in vol a good thing? Is this going to make regulators happier, or is this an investor? Investors want to see more volatility. What's your view on that?
So I'll go down two kind of rabbit holes on this question, Mike. So firstly, I think if we're trying to make an asset regulated and more commonly used, whether it's in Canada, RSP portfolios, in the US, I forget what your version of the RSP is, but whether it's going to be used for the mom and pop shops, for retail portfolios, we want to see less volatility, especially when the premise of Bitcoin is being compared to gold, right? You don't really see gold moving up and down 10, 20% in a day, right? You do have volatile days, that's for sure. But if you compare gold's volatility to Bitcoin's volatility, it's a lot lower, right? So from a mainstream adoption standpoint, I think less volatility is probably a good thing, especially on the downside, right? If there's high volatility, but the market continuously moves upward, people sometimes forget their basic investment principles. But especially on the downside, I think it's a good thing for mainstream adoption, and I think it's a good thing for regulators to kind of be able to look at the product and say, all right, volatility's calmed down here a little bit. The macro risk of this asset maybe has come down a bit too. So it's easier for us to look at how this can be regulated. But again, I think we'll dive a bit more into the regulation aspect of it. And then the second part of the question, which I touched upon a few seconds ago, was Bitcoin versus gold, right? So if we're talking about just mainstream adoption of Bitcoin versus gold, and we're having that narrative and we're having that conversation, then in my opinion, Bitcoin is a much better version of gold. But without saying that, if volatility is still high on one versus the other, and we're trying to use it as a hedge to other markets that are aggressively moving downward, it might not be the best hedge right now.
No, that's fair. So you opened up the regulation door for me there. So I'm gonna step in there for just a little bit.
Yeah.
What needs to be done? Like what are they just sitting on that? Because you and I talked about this several times. Is it regulation by enforcement? Is it regulation by rules? And what does that timeline look like?
So I think the biggest issue that we've seen, and I'll talk about North America primarily. I'm located in Toronto, and Canadian regulators seem to be a bit more flexible and innovative with how they want to look at crypto products. Hence why we have in Canada spot ETFs, and you guys don't yet. Your regulators are not comfortable with it. I think the biggest issue is you look at this sector and you say, who's left holding the bag? Right? Who's taking the biggest losses? If a company that has $2 billion in cash on their books takes a $50 million loss, it's terrible, but it's not the biggest deal in the world. They'll recover. If a family with $50,000 cash takes a $10,000 loss, and they're left holding the bag on some of these unregulated projects, well, that's a much bigger deal, right? So I want to kind of start there and say that given what happened over the last few months and how many retail clients were affected, let's not even talk about institutional for a second, let's just talk about retail. Given how many retail clients were affected, it really, really has sparked a new conversation with, US regulators and Canadian regulators, meaning that, if we have a new, without even getting into the security commodity conversation, it's more of, let's say you're an exchange or you're a platform that offers crypto to your users. How do you know that you're doing the right due diligence to add a new token to your platform, right? And Luna is probably the best example of this, and it's the elephant in the room, right? So if there was a regulatory framework that these exchanges or these platforms that offer crypto to their clients had, and they were able to go buy it, and regulators were actually up to date and understood how to analyze a project like Luna, maybe we could have avoided this. I'm not saying we would have, right? Because there was too many red flags around the project in general. But, if a framework is given, a much more clear framework is given on how the space can be regulated, both from the US and Canada, I think we could avoid situations like this. And now regulators have a forced hand to say, all right, well, a lot of people have lost a lot of money on not just Luna, on several other projects out there that have been on regulated platforms. Well, we need to add a framework to understand, firstly, what is this? Is this safe for Americans and Canadians to, be able to go out, purchase, and safely hold on to? Or is this something that we shouldn't allow them to invest into? Maybe I'll pause there because I might have gone on a tangent for a second.
No, that's great. And, I think you bring up a lot of good points there. And, you talk about decentralized versus, traditional finance. It seems like everyone wants decentralized until something like this happens. So let me ask you this, because you said it, you touched upon it a second. What's your opinion, SEC or CFTC?
Yeah, so you and me chatted about this.
Who should own it? Who should own that?
Sorry?
Who should own it?
Who should own it? It depends on what's a security and what's a commodity, right? And you have, you and I have chatted previously about SEC coming into certain exchanges that are not actually governed by the SEC and slapping them with fines. And same with the other guys, right? Without giving an opinion on who should own it, I'll say that somebody needs to take ownership soon and provide guidance rather than passing the buck back to one another, right? And you and I can get into politics, and under the current regime, will there be actual framework that it will be given, for digital assets? Maybe. I don't know. I don't know if House and Senate will agree. I don't know if that'll actually happen, but without actually giving an opinion on who should own it, there needs to be a clear governance around what is an actual security, right? Without asking the question a million times over, give a framework for it, right? We have the Howey test, but that's not helping, and it hasn't helped the space in years. I don't want to kind of say here what's a security and what's not, because there might be varied opinions across the board, but I think there needs to be a better framework given to actually analyze what is not, and then let that regulatory body deal with it.
That's fair. You did a very good job of avoiding your opinion. That was Let's switch gears a little bit. Let's talk about traditional finance and institutional investing in this space. How are we closer? I mean, we just talked about regulation needs to be there. No one wants to get fined. No one wants to be first in the space because they don't want to get fined. No one wants to be last because they don't want to lose out on market share. How far away are we from institutional investors, really diving in here? And what do you think that timeline looks like?
Yeah, for sure. So, as a company, as DB Chain, we've had many conversations with many banks, with many traditional financial institutions out there who are either interested in investing into crypto or interested in adding something for their users to be able to invest into crypto or trade crypto. So those conversations over the last, call it 3 months, have not decreased, at least for us, right? we're still seeing that institutional interest, and I'll dive deeper about it into it in a second. But those conversations have not decreased for us whatsoever, and probably companies like us as well,
When you
right?
say
There's still
the interest, Mike, is that like really just education? Like they really just want to understand how to get involved in the space, or they know what they want to do and they just want to be able to navigate the waters properly?
I think the education aspect was something that was maybe around 2.5, 3 years ago, a little bit more, where you get on the call with these guys, they just pick your brain on, how does settlement work, how to block confirmations work, who owns the asset at one point. Right now, it's more of how do we get involved? How are we able to look at the overall sector and get involved? Because they're seeing large companies like Binance, like Coinbase, basically, going out there and making billions of dollars on something that they could probably add to their platforms much quicker and in a much more trusted environment, right? So we are still seeing a lot of interest. That hasn't weaned, but the questions have increased, meaning what just happened in the market? Could this happen again? Could we see a trickle effect go down to other hedge funds, to other lenders, right? And unfortunately, we've been having these conversations for years. Well, it's not unfortunate, just an educational aspect of it. But now we're kind of, if we were here, right, we just came back down to here a little bit, because you now have all these institutions, whether they're public entities or whether they're holding billions of dollars for clients, these institutions asking questions about risk that they weren't asking 3 months ago. And to your point earlier, Mike, like, is that a good thing? In the long run, it definitely is, because it'd be better that, we get these risks out of the way now and understand how to build this ecosystem in a much stronger, safer, reputable manner, than have, large financial institutions come in and then, once they get a big scare, they just back out, right? Because I think that'll look worse, and people will ask more questions in that end. Another hesitancy for institutional players to come into the market, there's a couple of them, right? And you and I've chatted about this in the past. It's a lack of regulatory clarity. A broker dealer out of Chicago who wants to touch spot crypto doesn't know what that regulation is going to look like, right? And they don't want to mess with their traditional business. They don't want to ever take that kind of risk, right? So you have a lot of institutions that want to trade spot, as an example, but they're trading derivatives because derivatives are fully regulated, right? So lack of regulatory clarity would be one. Another one is who owns the asset, right? So there isn't an issue with custodians, but it's more of US regulators or Canadian regulators telling these companies, at what point do you have to custody assets? At what point can you hold these assets? Or who is the custodian that we as regulators trust for you to hold these assets, right? So I think there are still several questions that institutions are asking themselves, especially if they're looking to turn something on for their clients, whether it's a structured product, whether it's a trading platform. I think that's the biggest question. If you're trading for your own proprietary funds or investing for your own proprietary funds, essentially that regulatory landscape is a little bit smaller for you, in the sense that you don't have as many risks because you're not client facing. So I think those things are those are the questions that really hold some institutions back. But as we progress with regulation and as we progress with educating regulators, I think those questions will be answered.
No, you bring up a really good point, and custody comes up all the time. And along with that, insurance, like who's going to insure those funds and those custody accounts, right? Because as a being FDIC insured or whatever that may be. Let's switch gears. Let's switch gears slightly here. You and I have spoken in the past quite a bit about blockchain as well, right? So we've spoke about digital assets here and regulation, but let's just talk about blockchain technology, what that will mean for these institutions, how it's going to change the way they're doing business. Is everything going to be tokenized and instantaneous settlement down the road? And let's talk about blockchain technologies as it affects your regular retail consumer and your every average person that's using.
For sure. So we'll touch up on a couple of things here, but one thing you said is everything going to be tokenized. There isn't a need for everything to be tokenized, but when we're talking about what's being tokenized in the financial system right now, if you're an investment manager and you're rolling out a new fund, let's say you're a hedge fund, you're a VC fund, you're rolling out a new fund that's client facing. you can essentially tokenize that whole process, put it on the blockchain, and make it a much more efficient and simpler and safer way for your clients to be able to participate. And rather than giving them this much paperwork, right, you essentially issue a token to them, which gives them the rights, the holders' rights to be able to participate in that investment. Obviously, your KYC and AML stuff is done. You're not letting, Joe Schmo come off the street and say, here's $1 million, we're going into your investment with $1 million. No, your KYC AML is done. And, that's another use case of blockchain I'll get into in a second, but your KYC AML is done. And then once that's done and it can be verified, you essentially can, issue a tokenized product based on a traditional product. And I touched upon KYC AML. Every KYC AML at the moment in general, on a global aspect, on a national aspect, even on a state-by-state aspect, is very fragmented, right? A lot of institutions don't share this information with one another because they don't have to, A, and B, there's no efficient way to do it at the moment. If you can have trust anchors that are sitting on the blockchain that are able to work with some of the largest banks, some of the largest insurance companies to verify your ID and to make sure, you're the person that you say you are based on the information that you provided, it makes that whole system easier and safer as well, right? And it's a lot less paper, it's a lot less manual work, and just creates a more efficient process. So think about it this way. Imagine you have a tokenized, not tokenized, you have a KYC AML system that sits on a blockchain that can be verifiable, and then you use that KYC AML, whatever provider you're using at that time. I think eventually they'll all amalgamate together because you won't be able to have many providers here that are not sharing information together, because then the system won't work. But if you have that aspect of it, and then you have, let's say, a tokenized product, let's say ABC hedge fund as an example, not to name anybody, they have a tokenized product, how much easier is it for the consumer to actually invest, a consumer that's verified and is able to invest, and how much easier is it for ABC hedge fund to take on that investment, right? So that's just, I'd say that's one example of it, but there's many ways that certain blockchains can make the traditional financial system much more efficient and much easier to transact with.
Is it fast enough, or are we just in the early stages and it will be fast enough?
I think when you're comparing it to what we have right now, I think we're maybe not in early stages. Maybe we are still in early stages. Maybe we're in the second inning, right? We just passed through the first inning. Maybe we're in the second inning of it when you compare it to the traditional system. And, when you compare how many transactions can happen on the Visa network, or how many transactions are able to happen on the SWIFT network versus current state, let's say, of Ethereum, this is before the merge. So current state of Ethereum before the merge, it's not efficient. It's not as efficient as it could be, right? I think why there's so much fascination with adding blockchains to the financial system currently is because where it could go, right? So this is, to your point, we're still a little bit early. There are certain blockchains that can scale quickly and process thousands of transactions per second, but there's not many. And if everybody, for example, moves over to that blockchain and starts processing that, whether it's banks, insurance companies, money processors, whatever you're talking about, will that blockchain get clogged up? It might not, right? So we can't just have one or two or three blockchains out there that can process that many transactions, right? I think there has to be several, and then that'll give companies the ability to choose who they want to work with.
That's fair. And what about on the retail side? How do you see blockchain technology being consumed or adding value on the retail sector?
For sure, and I'll use an example here that I like to chat about. It's supply chain management, right? So let's just use a grocery store, for example. A grocery store is importing bananas from south of the border. And let's say 100,000 bananas ends up being, 94,000 bananas by the time they arrive, given, some maybe have gone rotten, some maybe have gone missing, right? So if you're able to actually track basically step by step without anybody coming in and editing what you've done before, it makes a lot more creative and a lot more safe supply chain. Meaning that, if let's say I'm shipping bananas over to you, Mike, and you wanted to eat, let's say, 2 bananas from the whole batch. You can just put into your system that you've only received this many bananas, right? And you could have said 2 are rotten, or you just didn't receive them. That would be the first step. If the next person wants to do the same, well, we've put on the blockchain that there's this many bananas. So now the proof is on you to verify that where did these 3 bananas go, right? And did you eat them? Or were they rotten? And if they were rotten, show us that. And I know it's such a basic example, but if everything's on a verifiable blockchain where we can actually see what's happening and the transparency behind it, it just creates a much more efficient system.
The topics come up several times with the grocery store, especially when you talk about suppliers. If there was disease or something, you can go all the way back down the blockchain. You see exactly where that specific item particularly came from. I just want to pause for a second, remind everyone there is a questions tab. If you have any questions about any of these topics or something that we haven't covered, please click on that questions tab. We will get to them. I did get a lot of questions early in the week, Mike, because I sent something out on social media. I'd like to hit a few of these questions if we have a few minutes to do that, or if you have some time available here.
Yeah, of course, of course.
One of the things that came up here, and as they're scrolling across here, that we didn't touch upon, and the question is, what do you think about stable coins and more so central bank digital currencies?
So two-pronged question. So stable coins, for firms like ours, and other crypto traders out there, it's an easy way to trade out of your position and decrease your volatility. And more so for stable coins, without talking about trading, you're able to move stable coins quickly with regards to money processing, right? Without volatility. You don't want, if you're moving money and you're doing it in a way where you don't care what blockchain it's on, then you might not be a Bitcoin maxi or an Ethereum maxi or whatever that case is, then you can use something like a stable coin. I'm not going to name any of them because there could be varied opinions on different ones, but you could use a stable coin to lower the volatility and be able to process that transaction quickly and efficiently, right? And certain stable coins are able to be processed on different blockchains. So depending on what the fees of that blockchain are that day, depending on how clogged up that chain is that day, you have the ability to process stable coin transactions on different blockchains. Now you touched upon a topic which I will be opinionated on, and that's CBDCs. So, we, as DV Chain and as myself, we're advocates of maintaining your privacy, and we're advocates of maintaining your data. And if you want my data, you got to pay for it, kind of thing. Very against what social media platforms have done for years and not tell us about it. And so, when you're talking about CBDCs, which is probably going to be the biggest control factor and the biggest spy mechanism for human beings in the last 100 years, other than maybe what we went through with social media, it's going to give governments the ability to essentially track every single transaction that you do. And as soon as we start introducing CBDCs, what stops the government from going to the grocery store or the convenience store or the local bodega because you're in New York? What stops them from going there and saying, all right, you guys can't accept cash no longer, right? And of course, people will still accept cash. And cash, Mike, you and me have chatted about this, cash will still be around. But if governments are not accepting it and the next transition is CBDCs, then that becomes a real big problem, because then every single thing that you do, every single penny that you spend your money on, someone is tracking it. Whether they're using that data to sell things to you, or whether they're using that data to predict your behavior, or whether that data is just sitting there because they don't know what to do with it at that time, it's still a huge invasion of privacy, in my opinion. It's great for the governments, right? Because the governments are able to actually, from an efficiency standpoint, control how much money is out there, can see the full supply of money out there, can see the full supply of money being used on a daily basis, right? It's a hugely efficient and great product for governments. But for human beings like yourself and myself, I'm strongly against CBDCs. Now, I'm just a voice, and DV Chain is just a company, and we can't control what's going to happen. But if out of all of the opinions you wanted me to give previously, this is the one that I want to give.
I wish I could retract that question. I think you just scared the hell out of everybody that was listening. No, but you bring up some really good points there. Let's just do one more question because we're pressed for time. Because this is interesting, and this might be a little more personal about your company. How is crypto being utilized globally, and what are some things that are happening out there that the public is not hearing about?
For sure. So a lot of the data and a lot of the news that we're seeing today is North American based, because you and I are in North America, or European based. When you talk about looking at news from South America, when you talk about looking at news from places like Africa, you have a lot of broken currencies there, and you have hyperinflation in a lot of those countries. That is really where I think that crypto is being utilized the most, that we don't talk about enough, right? If you wake up and the price, let's say you went to sleep yesterday and you had an apple that was worth $1, and you woke up today and the price of your apple is now worth $3. Well, your salary didn't go up 3 times, so your buying power has just gone down drastically, and you have no control over it, right? Whether the government decided to print a ton of money, whether your company, or sorry, your country is in hyperinflation mode because they're printing a lot of money, can't sustain a stable dollar. This is really where cryptocurrency comes into play, because one Bitcoin is always going to be one Bitcoin. Now, when you're comparing one Bitcoin to other dollars out there, let's say the US or CAD dollar, that's where the conversation changes. But one Bitcoin is always going to be one Bitcoin. One Bolivar it can always be one Bolivar, but the buying power of one Bolivar goes down drastically when the country prints billions of dollars and can't sustain a stable dollar. So we don't understand this enough, because we're lucky to live in places like the US and Canada where our dollar doesn't fluctuate by 15-20% in a day. Because if it did, we'd have bigger problems than we're seeing right now. Countries like that, whether it's Venezuela, whether it's Turkey, they need a more sustainable system that's out of government control. And that's where cryptocurrencies really come into play for them. And that's why you're seeing a huge adoption of Bitcoin in certain countries like that, and huge usage case, because a lot of these people in those countries, they'll earn the dollars that they earn in, whether it's Bolivar or Lira, they'll earn those dollars, but then they'll convert to Bitcoin or they'll convert to another cryptocurrency right away and in their minds, they're help sustaining the value of that actual buying power, rather than just giving it away to whatever their government wants to do. And in that sense, they're taking a bit of the control back.
Yeah, no, it makes total sense. It brings up a whole other topic of, infrastructure, connectivity, wireless, and access to web and all that. But we won't go down that rabbit hole right now. We spent a lot of time. We got 20 questions that we're going to have to follow up on here. Michael, listen, I really want to appreciate you for your time. I look forward to catching up with you again in person.
Always. And we can save any outstanding questions for the next one as well.
Thanks again. I'll talk to you soon, Michael. Have a good day.
For sure. Thanks, Mike.